Hello all, Keith Harwood here. I have our webinar from Wednesday. We had a few technical difficulties, so I am re-recording today. I apologize for the fact that this is not the official live webinar we had, but I wanted to get this out there for the information for everybody that is looking for that replay and that potential to watch the video again. Before we get started, we've got our disclaimer here. I want everybody to take a moment to read through this disclaimer, and then I can go into my disclaimer, my separate one, and then we can get right into the content that was from Wednesday. All right, that should be going. This disclaimer, we have the autumn options marketplace. So I've been trying to think through what we're expecting for the end of the year into that last quarter. That's what I really want to talk about now, where the market is today, and how I think we can progress from here. Before we do that, here are the standard disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Again, please read through the rest of these disclaimers, and then we will go straight into the good stuff. All righty. So I'm going to try to skim over some of the stuff that I've done or discussed in other webinars. Definitely go to optionhotline.com/webinars to see some of this information again. So I'm not going to do the long, drawn out conversation of who I am here today. That's generally something I like for the live participants. And since we're just doing this as a recording, just a quick one. Here's me. I started as a SIBO market maker back in 2005. I traded for proprietary trading firms, market making firms, hedge funds, and decided to go into the retail educational space because I think that there's an edge for us now. When I was a market maker, the edge was for the market maker. Markets were wide. This was going into the subprime crisis. When I was a proprietary trader, I thought the edge was there, having a bias on those directional moves. And I think that edge still exists, but it's better suited than ever for the retail investor because markets are a little bit thinner in various cases. And frankly, I think that seeing, market makers and hedge funds take advantage of regular people didn't necessarily make me feel good about what I was doing. I would rather help those that have maybe trading errors in terms of their implementation do better. And so that's what we're going to talk about today, is how to do better, or how to do as well as we can in the current market environment. If anybody needs to email me, throw me a line on email, keith@optionhotline.com. I'm also, here's my phone number as well, in case you want to talk via the phone, but the best way to get hold of me in general is via email. All right, so what are we going to discuss today? The standard kind of why I use options and the long-term trends that are existing in the market right now. We're going to talk through those moving average signals and where they're holding and where is current support. And then finally, I'm going to give you the good stuff, how I implement the trade given the current market setup. First off, always want to talk about max profits bundle. This is performing exceptionally well since inception. I should have started it a month later instead of starting it right before the COVID collapse of March of 2020. Wish I had started a month later, but at the end of the day, we're talking about trading the trends in NASDAQ and the S&P 100 doing well, very well relative to the S&P 500, and also having defined risk, because all of this is using options. We keep a hefty cash basis in these portfolios in order to define the risk and minimize the loss so that we don't have a potential for 100% drawdown. We want to have, potential for much, much less. So as you can see, about, an S&P 500 account would have gone from about $70,000 up to about $100,000. So call it a 30-40% return versus doubling by using options and trading the trend. And that's what we're going to talk a little bit more about today, is trading the trend using options. As a reminder, options always have risks: transaction costs, assignment, decay, volatility. For most of you, I'm sure that these are kind of a recap of stuff that I've talked about before. I'm going to try to skim over some of this stuff because they're not as relevant to the current market environment as the charts near the end. If you do have questions about options having risks and some of the options analysis, take a look at my last webinar and you can get a little bit more of a conceptual discussion of that again. But due to the technical difficulties, I'm going to try to really get us over into the actual charts and what I'm using as my entry levels going forward. So first off, why do I use options? This is my standard stock chart. It's linear. If I buy 100 shares for $100, I've got $1,000 of downside if the stock drops by 10 bucks. I've got $2,000 of upside if the stock goes up by $20. But there's that risk, especially with what we saw on the 28th, which is Monday. You could have a gap down in an individual name or an entire marketplace and go well below your stop loss. And that's particularly true right now because our stop loss would be considerably tighter to current market conditions than often. So looking at a stop loss really close to where the market is right now, that can create some potential for increased risk beyond what is initially considered. With an option, however, the max loss is how much you spend to buy the option. So as long as you're buying options, max loss is the expense paid. If you're selling options, max loss is whatever it can maximally be worth. So if you sell a $100 put, that put could be worth $100 if it goes to zero. If you sell a $100 call, there is unlimited risk to the upside. In our case, what I'm talking about here is buying the $100 call and buying twice as many so that I have double the leverage, because 2 calls represents 200 shares in terms of buying power, so that if the stock goes up the way that I'm looking for it to do, I get a better return. And you can see that here, above $110, 2 calls are better than 100 shares. Below $90, 2 calls lose less than 100 shares. And anywhere in between 90 and 110, stock is better. So what do I want to find when I'm looking for a stock? I want to find a stock that I think has this kind of upside, but if I'm wrong, I think has this kind of downside. I want to have a situation where I think there's leverage and I think there's potential momentum. But if I'm wrong, I certainly want that defined risk. Otherwise, I'd be better off in the stock. If I think that this stock is downside is to 98 bucks and the upside is to 104, well, then I might as well just trade the stock because I'm going to do better than I can normally do in options. But if I think there's a chance that this stock could go to 120 or $130, I'd rather trade into the option space. And in particular, if I think that we've got a scenario like what we've got right now, where the bottom could fall out of the market and lose all liquidity, I need to have that defined risk. Now, when you're valuing an option, it's all about implied volatility. This is estimated by the trader. That is the one input that we options traders can throw into the model. The rest of it is given. So the market tells you what the market maker thinks implied volatility should be. But if I can combine both an underlying price directional bias with an implied volatility bias, I can make a lot more money than just having an underlying price bias or just having an implied volatility bias. And the reason is because if I think that a stock's going to go up, then I can get my sale prices at the right spot at the right time. So with VIX near recent highs, I don't want to buy these out of the money options because I think the VIX right now is a little bit overpriced. So if implied volatility is high, I'm paying a premium to buy every option. Every option on the board, I'm paying a premium. But the premium is less for in-the-money options than it is for out-of-the-money options. For in-the-money options, like the $94 call on my $100 stock, I'm paying a 9% premium. If I do this with an out-of-the-money call, like the $106 calls, I'm paying a 30% premium, 29%, but you get the idea. The problem here is that even though I might have a directional bias, my premium bias is that options should get cheaper. So you could look at something like a debit spread or a call diagonal or something like that. But to try to simplify things, I like to just find the cheapest option I can. So I'm not necessarily looking at a debit spread right now because I do think that there's potential for a big move to the upside. But what I'm doing is trying to find that big move to the upside and mostly defining my risk in case that crazy downside move. When the VIX is at 23, I don't want to buy out of the money options unless I really, really shorten my time to expiration. When the VIX is at 16 and the market looks like it wants to break out and it actually does, then I'm interested in out of the money options. And here's the reason why. You can see the side by side here. When implied volatility is low, that leverage from those out of the money calls, the 106 calls, you can see is huge. $6,000 versus $2,000 for stock. But when implied volatility is high like it is right now, it takes so long to get to that break even relative to stock that it's not great. So my big advantage is defining my risk. And I can do that with a $9,400 call or the $100 call. I don't need to buy the $106 call to define my risk. We can zoom in on a little more here and see that, I've got these $106 calls would be break even at 108 and huge leverage at $120 if implied volatility was cheap. But when implied volatility is expensive, it's not huge leverage up really even at $120 a share. What I'm really trying to achieve here is the ability to use less capital and define my risk. So I can buy the $94 call, that in the money call, and use less capital, $1,000 instead of 10,000, have the same roughly upside as stock, and have 90% cash. And that 90% of my portfolio that's in cash can either be used to add other stocks to add my leverage, or it can sit in cash to define my risk and say, I'm only willing to risk 10% of my portfolio right now. That's what I'm looking to do, is to actually take, it's not going to be 90% cash and 10% in the trending stock portfolio, but maybe I say I'm going to stay 30% cash. And if I'm 30% cash, 70% in the market, but out of that 70%, I'm now as leveraged for each 10% as the whole market. I've got 7x the market leverage, even though I'm still 30% cash. Now, nobody wants to take that full 70% drawdown in your portfolio. So maybe it's a 50-50, maybe it's a 40-60. All of this comes down to your individual risk tolerance that should be likely discussed with your financial advisor. But the idea here is that you can leverage and define the risk if you use in the money options, even though traditionally people talk about leverage coming from out of the money options. Here, we're talking about ways to leverage in the money options, and it's particularly crucial when implied volatility for the overall market is on the high side. These long-term trends that I'm looking for require longer-term options. So when I'm swing trading, I'm looking for under 30 days, maybe 45 for timed expiration. But when I'm long-term trading, I start with 3-month options, maybe 4 or 5, and then I continue to roll them. So I'm always in a little bit longer term option to start. So I start with a longer term option, and I say long term is like a quarter or nearly half a year, not multiple year options. I think that you just don't get the good liquidity for those, and you can replicate that return by using something expiring in 3, 4, 5 months without having to give up the liquidity of 1 or 2 year out options. So adding these long-term trends with options both gives me that leverage that I discussed, and it defines my risk. And I can add a stop loss on top of that so that I'm not risking 100% of that trade. When I deal with a swing trade and out of the money options, I have to assume that if it all goes poorly, I'm going to lose 100% of my initial premium. With trending stocks, that's normally not the case. There are opportunities to exit before the option goes to zero. And that, again, is the philosophy that's used for the Max Profits Bundle. This is the S&P 100 and NASDAQ 100 trending stocks for utilizing options. And again, you can go to optionhotline.com/subscribe right now and find this bundle. It is a cheap bundle. It gives you great opportunity to understand the market, diversify around the market, and understand the educational benefit of trading a trending portfolio. All right, so now let's talk about the 3 main sectors right now. The S&P 500, which is the broad market, the Russell 2000, which is the small caps, and the NASDAQ. These are the three that I'm looking at right now. And if you were to look at the S&P 500 today, you'd say, it looks a little weak, but I got a bunch of lines on this chart that are telling me that maybe it's not that weak after all. Which line on here looks good? The yellow line. What's the yellow line? Stay tuned. I'll tell you in about 2 minutes. When I look at the Russell 2000, the red line looks pretty good as a potential support level. Maybe that's holding the market above that. Or we're looking at potential downside to recent lows. That's not too far away. So maybe the small caps look okay. And the NASDAQ, I mean, we've had lows made in July and August and September and whatever. Every month we seem to get one of these little dips, and they always seem to hold. And again, the yellow line looks pretty good for a short term, we'll call it support level. Now, support levels are those levels that we struggle to go below. We'll come back to that in a few minutes. But here's what you've got right now is a market that's trying to see if it can break. And I'm not sure it can, because we have so many levels that computers are willing to buy against. So let's talk about simple moving averages. Those are all those lines we saw. Simple moving averages take the average closing price over a recent period. Most normal common ones are the 10, 20, 50, 100, and 200-day simple moving average. Those don't have any logical reason other than the fact that they are round numbers. 10 days is 2 weeks. That makes some sense. 20 days is almost a month, 22 trading days per month on average. So close enough to making sense. 50 days, 2.5-ish months. I don't know, it's 10 weeks. 100 days. Yeah, that's 20 weeks. That's about 5 months. I don't know what the logic. And anyway, then 200 days is, again, 40 weeks. So we're not talking about a round number. It has nothing to do with a year or a quarter. Quarterly could make some sense because every quarter we announce new earnings. But a quarter, 3 months, should be around 12 weeks, which would be 60 days, or every, semi-annual would be 26 weeks, so 130 days. The reason these numbers matters because everybody looks at the same damn numbers. So everybody's looking at 100 and 250 and 20 and 10. So these numbers matter only because it's a self-fulfilling prophecy that people look at them. Now, if we're above those key moving averages, it means the average buyer over that time frame is making money. If we're below that key moving average, the average buyer over that time frame is losing money. So that's why they matter. It's because if we're above the 10-day moving average, the average buyer for the last 2 weeks is making money. If we're above the 200-day moving average, the average buyer for the last 40 weeks, I guess 3/4 of a year, is making money. So that gives confidence to the bullish biased trader if a lot of people in the short, mid, and long term are making money. Where we're at right now in the S&P 500 is, well, we're below the 10, the 20, and the 50, but we're above the 100. So the long-term investor, we're talking retirement accounts, is making money. The short-term investor, the trader, the active day trader, might be losing money if they're buying right now. Or the short-term active trader is making money by getting short the market. So that starts to tell us a little bit of what's going on. You got short-term sellers making some money and long-term buyers still making money. So I'm looking for ways to buy the dip. And the key for me is actually a triple moving average system. I can compare the 22-day, so 1 month, the 89-day, so 4 months, and the 148-day, so 7 months, moving averages to achieve a goal of determining whether there's momentum and the long-term trend. So when the short-term moving averages, you've got the 22-day here in purple, the 89 in green, the 148-day in blue. When the short term is above the medium term is above the long term, that tells me that the trend is higher and they're still buying momentum. Now that purple line might go below the green line here in the next few days. If we keep falling, it's going to happen. But if it doesn't, it tells me that not only is short-term momentum, not super short-term, I'm not talking the 10-day, I'm talking, again, that 1 month time frame, buyer still making money, but everybody in every other time frame is probably making money too. So yeah, we're below the 22-day moving average, but the fact that it's above that midterm and that long-term moving average tells me that the momentum is still higher, even if it feels like a short-term blip. And that's the key. If I find the stack where purple is above green is above blue, I'm interested in buying. And the market right now has a number of those stocks where purple is above green is above blue, even if the current stock price is below the 22-day moving average. That's okay. As long as we hold those other key moving averages and support exists, we are okay. Support is the price that the stock has difficulty going below. It's a price where the stock has more aggressive buyers than sellers. Do we have that in the S&P 500? Absolutely. We are struggling with it right now, but we have that support at the 100-day moving average in yellow. I will draw on here just to make sure it's clear because the yellow line is a little bit light. There you go. There's your 100-day moving average. We tested it on September 20th. We tested it again this week, but we're holding. And every time we try to go below, the market finds an aggressive buyer and we recover. That's a good sign for the bullish bias trader. When I go to small caps, support is a little less clear, but it looks like we're just creating a giant wedge. So we've got these lows all lined up. We've got these highs all lined up, and we've got descending highs and ascending lows. We're coiling the spring. This is not a trend trading environment in small caps. So yes, the 200-day moving average is a traditionally good support level, but it doesn't matter right now because we have an ascending low and a descending high. We are creating a wedge. This is a swing trading setup if and when, and it's not if really, it is when we break out from the wedge. It's tightening, it's tightening, it's tightening. Eventually, we have no choice but to break out. So you have to understand, at some point, we will go below 216 or we will go above 229. And every day that wedge gets a little tighter. So instead of 216 to 229, it becomes 217 to 228, 218 to 227, 219 to 226. We're tightening the range for the breakout. And then we finally have to break through because eventually that range goes to zero. So if we don't break out in the next week, we just have a tighter range for our breakout. So we're really, really close to that in small caps. But again, I'm not looking for anything related to trend trading in small caps. As a result, I'm looking for swing trades there once that range is dealt with and we get that move. NASDAQ, on the other hand, has multiple support levels. So NASDAQ has been our leader as a reminder. First off, we've got the 100-day moving average there in yellow. We've got the low from July. We've got the low from August that we've actually started to test below. So we've got all these support levels that can and probably should hold. Now, traditionally, when I look at moving averages, I find that if the 10-day moving average fails finally, then the 20-day moving average holds temporarily. And then if that fails finally, then the 50-day moving average holds at least temporarily. So you can clear out all these lines and you can see it. When we've gotten the break below the 20-day moving average, which was support all the way from really June through mid-August, a couple months, we tested the 50-day moving average and bounced. So then in September, we tested the 50-day moving average. And when we couldn't hold the 50-day moving average, we went straight to the 100-day moving average, which is where we're at right now. So if that support holds at the 100-day moving average, which also sort of correlates with this July low, this creates a great opportunity for me to take an in-the-money call option with defined risk, knowing that if these support levels don't hold, I have to get out in order to play for a move to the upside. The upside here being about 383 in the Qs. So if I think that we've got about 6% upside, 5 to 6%, or actually more than that now, 23 bucks on 380, we're close to 7%. So about 7% upside. My risk is down to the 100-day moving average, which is what? 1% downside. So if I have 7% upside, 1% downside and I can leverage that, that's a good trade for me. So I just have to time that entry, which is all I'm working on right now, is trying to time that entry in order to leverage the upside move that is holding. Because oftentimes when we find support, we retest the high. And then sometimes after we've tested support, like we did here in July, we sit at the high for a month. So if we test support and go back to the high of 383, maybe we sit there for a month. I don't want to have options expiring in a week if we're not going to move for a month. This is why I use longer term options to trade a trending market. All right, we've kind of wrapped this up, but let me give you the how I use options for trending markets. Once again, I find a long entry that fits my triple moving average signal, mentioned earlier. I look for a sector where support is holding, which is what we're doing right now. This will help me define my stop loss, which I mentioned already, and make a lower risk entry while also adding leverage. Then I structure my trade with 3 to 5 months to expiration and 65 to 80 delta. Right now, I'm kind of looking around 70-ish delta, but you get the idea. We're talking about an in-the-money option with a 2 out of 3 or 4 out of 5 chance of finishing in the money. So we're talking about high probability options of finishing in the money, high probability options in general, a little more stock replacement with defined risk. It's a great way to trade trending stocks, in my opinion. And that's what we do for that max profits bundle that I mentioned. This is how we've performed relative to the S&P 500 by trading those trends in the NASDAQ and S&P 100. Finally, once again, if you have any questions, you can feel free to email me, keith@optionhotline.com, or call me 312-600-8004. For those that attended live, you will still get the free giveaway from webinars at optionhotline.com. For those that did not sign up and are interested in the free giveaway, make sure you sign up for the next webinar to get that free giveaway. optionhotline.com/webinars in order to sign up next. optionhotline.com/subscribe to get the good deal on the max profits bundle. Thanks again to everybody. I apologize for the technical difficulties, but I hope everybody watching this on replay got close to the same amount of value as those who were able to watch live. And please do everything you can to watch live next time, because you never know when technical difficulties are going to come up again. Thanks again to all.